This one is easy to get wrong. Internally managed versus externally managed REITs. What is the difference and why do investors care? 5 seconds, answer out loud. An internally managed REIT employs its own executives and staff, with costs running through G&A. An externally managed REIT pays a separate manager fees, typically based on assets or equity under management, sometimes with incentive fees. Investors generally prefer internal management because external structures create conflicts. Fees tied to asset size reward growth for its own sake, even dilutive growth. The manager may allocate deals across multiple vehicles, and termination fees entrench the manager. Externally managed REITs consequently tend to trade at valuation discounts. An internalization of management is a common value unlock event. The counter-argument for external management is access to a larger platform for smaller REITs that cannot support full infrastructure. Blank, survived, or banked? Put your score in the comments. 20 cards in every drill are free at WACCbuddy.com. Do your reps. Your competition already knows this one. When is EV gross profit a better multiple than EV revenue for tech companies? 5 seconds, answer out loud. When the comp set mixes business models with very different gross margins, e.g. an 85% margin subscription software company against a 60% margin usage infrastructure business, or a 30% take rate marketplace against a gross recognized e-commerce player. EV revenue implicitly assumes every revenue dollar has equal earnings potential. EV gross profit corrects for the first and biggest driver of that difference, since gross profit is what actually funds OPEX and eventually margin. It is especially useful for fintech, marketplaces, and consumption businesses where revenue recognition conventions, gross versus net, make revenue itself non-comparable. Limitation: it still ignores OPEX efficiency and growth durability, so it complements rather than replaces the full analysis. Blank, survived, or banked? Put your score in the comments. 20 cards in every drill are free at WACCbuddy.com. Do your reps. Today's rep. When valuing a distressed company's going concern equity for recovery purposes, why might you not use the current depressed trading multiple? 5 seconds, answer out loud. Current distressed multiples reflect the over-levered, financially stressed entity in a forced seller illiquidity discount, not the operating business post-restructuring. For recovery, reorg valuation, you value the deleveraged, normalized business. Using normalized EBITDA, your cash flows and multiples from healthy comparable companies, or a DCF on a sustainable capital structure. The capital structure problem, too much debt, is distinct from the operating value, so you strip out the distress to estimate true going concern enterprise value. Blank, survived, or banked? Put your score in the comments. 20 cards in every drill are free at WACCbuddy.com. Do your reps. This question ends Super Days. What is the difference between operating synergies and financial synergies? 5 seconds, answer out loud. Operating synergies improve the operations of the business. Cost savings and revenue gains that raise EBITDA, operating cash flow. Financial synergies improve the financial profile without changing operations. Lower combined cost of capital, greater scale diversification, higher debt capacity. Tax benefits, using the target's NOLs, step-up amortization, which only arises in a taxable asset purchase, or a 338H10 336E election, not a plain stock deal, and interest tax shields. More efficient internal capital allocation, and reduced cash flow volatility. Strategics emphasize operating synergies. Financial synergies are real but often smaller and more deal-specific. Blank, survived, or banked? Put your score in the comments. 20 cards in every drill are free at WACCbuddy.com. Do your reps. This one is easy to get wrong. Walk me through a typical leveraged buyout debt capital structure from top to bottom. 5 seconds, answer out loud. From most senior secured to most junior revolver, Senior secured, undrawn liquidity backstop term loan A. Senior secured, amortizing, bank-held term loan B. Senior secured, minimal amortization, 1% per year. Institutional, CLO held second lien. Secured but behind the first lien on collateral senior unsecured notes, high-yield bonds, subordinated, mezzanine debt, often with PIK and/or warrants. Preferred equity, common equity, the sponsor. Higher in the stack, Achar, more secured, Charcher, senior, Charcher, lower cost. Lower, Achar, riskier, Charcher, higher cost. Pricing rises as you move down. Blank, survived, or banked? Put your score in the comments. 20 cards in every drill are free at WACCBuddy.com. Do your reps. Today's rep, the 8-ball weighing puzzle. You have 8 identical-looking balls. One is slightly heavier. Using a balance scale, find the heavy one in the minimum number of weighings. 5 seconds, answer out loud. 2 weighings, weighing 1, split into groups of 3, 3, and 2. Put 3 versus 3. If they balance, the heavy ball is in the leftover 2 to weigh those 1 versus 1. The heavier side is it, weighing 2. If one side of 3 is heavier, the heavy ball is among those 3 to take any 2 of them and weigh 1 versus 1. If one is heavier, that's it. If they balance, it's the third untested ball, weighing 2. Key insight. A balanced scale gives 3 outcomes, left, right, equal, per weighing, so 2 weighings distinguish up to 32, 1 or 9 cases. Enough for 8 balls. Splitting into thirds, not halves, exploits the equal outcome. Blank, survived, or banked? Put your score in the comments. 20 cards in every drill are free at WACCBuddy.com. Do your reps. This question ends Super Days. How does a Dutch auction IPO work, and how does it aim to reduce underpricing? 5 seconds, answer out loud. In a Dutch auction, e.g. Google 2004, investors submit bids stating price and quantity. Bids are ranked high to low. The clearing price is the highest price at which the full offering can be sold, and all winning bidders typically pay that single clearing price. By letting market demand set the price directly, it aims to capture more value for the issuer and reduce first-day underpricing and discretionary allocation. Though in practice results have been mixed and adoption limited. Blank, survived, or banked? Put your score in the comments. 20 cards in every drill are free at WACCBuddy.com. Do your reps.